What's going on, guys? Welcome back to the Good Success Quick Tips. I'm Josh Culler, and back with me again we got Tom Olson, who has done several quick tip videos in the past, and so you guys make sure you go check those out. Today he's going to be talking about a little bit of an interesting topic that he's done a lot of studying on. It's something that's very interesting and this is going to be specifically for you real estate investors out there, and this is how to predict the next market crash, the next bubble for housing. And he's talked about this in our Good Success Mastermind. I thought it was very intriguing, and so he's going to talk about that today, give us a few quick tips on what's going to happen, and then we're going to be looking for a podcast pretty soon on this, by the way, too. So be on the lookout for that. So what do you got for us, Tom?
Yeah. So where are we at today? Where are we at in the real estate cycle today? So I mean, if you don't know that there is a cycle when it comes to real estate, there is. So number one is just to be aware that there is a cycle. Be aware that on a natural trend, like real estate's going to go up and real estate's going to go down. It does have a natural tendency over the long haul, 100-year type of deal to go up in value. And really, I mean, my question to you is, does it really go up in value, or does our dollar just become worth less? Which I think it's probably a little bit of both. But I mean, either way. So I think the very first thing to understand when it comes to the real estate cycle itself is that there are four main phases in the real estate cycle. And so I'm just going to kind of go over those a little bit in this quick tip video, and I'm going to just maybe explain what they mean and maybe help you a little bit today. So the very first stage or phase in the real estate cycle is what you call recovery. So I'm just going to kind of start at the bottom. This is when you've come out of a recession. This is after things have crashed already, and you're going to kind of come out of the recession. So that the very first stage, like I said, is recovery. So you have to understand that there are two main things, or I should say one main law that really has to do with, that controls real estate, and it's the law of supply and demand. And so as you see, as we go through these different phases, you're going to see a direct correlation to that supply and demand thing. So that law. So the very first thing you need to think about is that recovery. So this is like the bottom, and it's come off the bottom, and it's gone from the bottom, and it's starting to maybe make its rise up. It's not on that middle line yet. So just imagine there's this middle line, and this is that from that bottom to that middle line. That's where the recovery stage would be. So in this stage or this phase, you're going to have declining vacancy. You're not really going to have a lot of new construction in this phase. So a lot of times people are still afraid to do new construction. People are running away from doing construction during this phase. And after you get out of this phase, there's the phase two, which is the phase of expansion. So this is when people have gotten confident enough for new builders to build new houses or to build new apartment buildings. So during this stage, you're going to see a lot more of new construction, and you're going to see declining vacancy. So vacancy rates are typically a lot higher when the market's low, and they're a lot lower when the market's higher, right? So again, pay attention to that, because at the end of this, I'm going to wrap it all up, and that's going to be one of the main points to understand. Now, from that middle line, or you might want to call it the mean line, so that middle line to the top of the market, from when it's going to kind of come back over, like I said, from that middle line up, you have this expansion phase, but then you have from the expansion phase down back to the middle line or the mean line, you have hyper supply. So the reason why you have those peaks and they start to go down is not necessarily just because of economics. If you study history, you'll see that not all economic downturns also have housing downturns at the same time. So housing has its own really 18-year cycle. People talk about a 7-year cycle in economics, but really for housing, you go back. There's a whole study done on it, and I'll show you some of the slides here that I'm looking at here that tells you the peak in land value, the peak in construction cycle, and the peak in business cycle. And these are all a lot different. They don't always necessarily correlate with each other. Sometimes they do match up, and sometimes they don't. But housing only goes off of supply and demand. If you have more supply and less demand, then guess what? That's what happens, and that's when you get to that hyper supply, when you've got more supply and not enough demand for the supply. So when you're in a hyper supply, you have too many houses or too many units in the market, and you have increased vacancy, right? So and a lot of times new construction is being completed during this stage. So a lot of new construction is being completed, and as it all comes out of the market, you're having too much product or too much supply. So you have hyper supply, right? So too much product, hyper supply. And then the very last stage is when it's reached back down to normal levels over maybe a 200-year period of time, and it goes down into recession or a housing recession. That's the fourth stage. And obviously after that recession stage, naturally over the last 200 years, we've had a recovery stage again. So, just because we're in a recession at some point in time doesn't necessarily mean we're not going to have that recovery. We always have, and I believe that we always will. So during that time, you're going to have increased vacancies and you're going to have even more completions of new construction. So understanding that those exist and understanding where you're at in the cycle, I think is very important. And I think today in most places in the United States, most places we're over that midline. We've come out of recession and we're already back up in that expansion stage. And I think you need to pay attention to your market. You need to be prepared, because I will tell you, from my opinion and from the opinion of most of my advisors, the people that I travel around the country, we spend at least $100,000 a year traveling and going to masterminds and going to places where we learn and networking with people that are in the know. And I was just at a conference in Miami a couple of weeks ago, and they talked a lot about where we're at, and they talked a lot about where most places there's not really value to buy, except for maybe the Midwest and the Southeast. And as far as the United States goes, those are the places that still the big players in the market are buying, and because they know that there's still value there, or they know that it's more of a boring market and it's not going to have the major ups and downs in a typical market. But I would tell you we are probably in that stage somewhere, and I would tell you also real estate's become extremely local. So pay very close attention to your local market, but I'd also pay very close attention to the national market, because different things happen in different parts of the country at different times, and if they've happened in other parts of the country, they're probably going to happen to you at some point. So what can you do now to prepare for this cycle correction? It's going to happen. So that's the very first thing to know, is that it's going to happen. I don't know exactly where we're at, but at some point we're going to have some kind of market correction. It's just inevitable. It's always happened, and I believe it always will happen. When that happens, don't be afraid. So don't be in this stage being afraid of this market correction. Be prepared for it. Prepare yourself now for it. So what I'm doing right now is I'm trying to build a stronger cash position. So I would recommend to most people 15 to 20% cash position if you're an investor in real estate. I think it's a very wise move at this point. So keep that in mind. The next one I would tell you to do is pay off debt as quickly as possible. You don't want to be in the bottom of a real estate market if you're a real estate investor and you don't have a lot of cash. There's one thing that hurts me to the core. In 2008 and 2009, we sold so many houses for like 1/2 to 1/3 maybe of what they're worth today, just wholesaling these houses. So we wholesaled hundreds and hundreds of houses that if we would have just bought them and held on to them, if we had the cash to do it at the time, I could have made millions and millions of dollars extra more than what we have done in this past 12 years. So build a strong cash position, pay off debt, build cash flow drivers that perform in any market cycle. Try to find ways that you can have cash flows that are going to work in any market cycle. So a rental is a great way to do that, because like a lot of times when you own a rental, sometimes the rents go up during bad economic times like they have for me in the past. But that's just one way. There's lots of other ways. Get rid of waste in your business. Get rid of waste in your personal run rate as well if you possibly can. Stop doing activities with lower profit margins. Invest more time and energy into places with higher profitability. Develop contacts and advisors that have been through the recession. So you need to be looking towards the people that went through the last recession or went through the last 2 recessions, and start connecting yourself with them so that they can help you guide your way through the next market correction. So I would look to those people that went through it. I would look to the people that went through it and crashed, but I would also want to look towards the people that avoided it. They might have went through and they decided not to participate in the last recession because they were prepared the last time. Don't just go for the people that crashed and burned and now they've built themselves back up, but also go through the very smart people who knew it was coming last time, and they're even more seasoned than just the people that went through it last time. And figure out what they did to avoid it, because you want to avoid it, but you don't really want to avoid it. You want to participate in the upswing and be ready for it. Obtain favorable lines of credit. So in cases that it might be needed, you don't ever know. So I would highly recommend get with the local banks. Get with the local banks, get lines of credit, get unrestricted guidance lines of credit. That's what I would be doing right now. Renegotiate fixed expenses with lower fixed monthly expenses. So that might be your payroll, that might be other things that you can do, but try to get a lower fixed expenses if you can. Streamline your processes and eliminate activities that do not contribute to adding value to your customers. So if they add value to your customers, don't get rid of them. But if they don't add value to your customers, find a way to streamline them so they're more automated and they cost you less money. But I mean, that's the worst thing you can do, is not continue to add value to your customers. But if you're add value to your customers, keep spending money there. Create a cost structure that is more variable with sales. So like if you go from super high sales and all of a sudden you go to low sales and you don't have a little bit of variability in this, you're going to be stuck. And I just warned you of that. Calculate your break-even point and stay well below it. So live well below your means. I don't care if it's personally or if it's in if it's your business. So live well below your means. Stress test your business. I would tell you, if you're making 20% less in any given month than you're making currently and you're not making it, well, there's probably a problem. So stress test your business, and just whether it's 20% down in sales, 20% down in acquisitions, 20% down in revenue, stress test all of your KPIs and make sure that you can still stay in business and withstand some kind of correction. Make sure your back-end operations are the best in the industry. And I'll tell you, efficiency is where you need to focus right now. Focus on operations. Focus on being as absolute efficient as you can, not wasting time, only having people in the business that are adding value to your business and adding value to your customers. And at the very end, the very last one is share your knowledge with other people. Let other people know, hey, this is coming, and because you know what, at the end of the day, this is going to give you more influence in the market, because people are going to start saying, hey, this guy knows what he's doing, he's helping me. And when you do help those people because you prepared yourself and you're ready for the next market correction, and you not only get to not participate in the downturn yourself necessarily, but you get to participate in the possible upswing that's going to happen, like, you're going to be the person that everybody's going to want to come to. And influence at the end of the day is what I'm focused on. And I hope that helps you today. If there's anything we can do for you, please let us know.
Awesome stuff. And be on the lookout for a podcast about this, because we're going to bring it up pretty soon for maybe an Active Turnkey Tuesday or a Successful Saturday. Probably work with either of those. So thanks, Tom, for sharing that with us. We appreciate it. And if this did provide value for you guys, make sure you give it a big thumbs up and subscribe to us on YouTube or like our Facebook page, however you're coming to us. And thank you guys for watching. Catch you on the next one.